Hello everyone, I am Sonam Udasi. I manage the Tata India Consumer Fund. This fund is a sectoral fund that invests at least 80% of its net assets in equity and equity related instruments of companies in consumption oriented sectors in India. The fund has completed over a decade since inception and has been positioned to participate in India's structural consumption story. If you look at the India consumption backdrop, there are a few structural anchors we come back to. India is one of the youngest and most populous consumer markets globally, with a median age of around 29 years. Per capita income is trending upwards and is expected to potentially double over the next 6 to 7 years based on internal and external estimates. With more women joining the workforce across Tier 1, Tier 4 cities, segments such as ready-to-eat, food processing, quick service restaurants, also known as QSR, ordering in, and consumer appliances are likely to benefit over the medium to long term. Our fund strategy is to capture emerging consumer trends across categories while remaining true to the core consumption theme. As a philosophy, we do not invest in debt-heavy segments or corporates, and we aim to build the portfolio around companies with structural growth potential. Looking at our current positioning, we are overweight on both discretionary segments and fast-moving consumer goods, also known as FMCG. Discretionary because penetration levels in these categories are relatively lower and offering scope for potentially higher growth as per capita incomes improve. Within FMCG, we are overweight led by food-focused companies and select traditional staples. Let me talk about the categories we are actively playing. In consumer durables and appliances, we have exposure to production-linked incentive plays, also known as PLI, driven names, and we have been actively booking profits and re-adding on corrections in this segment. Within FMCG, we have added newer names in the beverages and food processing space, while we have exited select detergent-oriented names. In consumer services, we remain overweight, given the strong long-term growth potential of quick service restaurants, eating out, ordering in, and the e-commerce aggregator businesses. In financial services, our exposure is not to lenders, but to scalable digital business models. In automobiles, we have taken exposure in electric vehicles, also known as EVs, focused stocks that have medium-term growth potential. We have also exposure to auto-focused platforms. We have also recently added exposure to telecommunications through a sector leader and added to our healthcare positions. Coming to the sector consumption backdrop, stable volumes have been steady, while cost pressures have started to build up due to the elevated crude-linked input costs. The full impact of higher raw metal costs could reflect more meaningfully in margins during the first half of the next financial year. Within discretionary, jewellery and alcobev segments have been very resilient, while QSRs have seen some near-term softness. Consumer durables demand has been mixed, and paint companies have taken price hikes to protect margins, which may create working capital pressures for smaller players. From a risk perspective, if crude oil prices continue to stay elevated for a longer period, some categories with commodity-linked input costs could see near-term margin pressure. Any moderation in consumer sentiment or delay in urban demand recovery could also weigh on the sector in the near term. For investors looking to participate in India's long-term consumption story through a thematic lens, this could be a suitable option to consider with a medium to long-term investment horizon. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.